Good morning, everyone, and welcome to Weekly Profit Talk. As you might imagine, we do this every single week. We do this on Wednesday, 8:30 a.m. Mountain Time, every single Wednesday. If you are in Pacific time zone, that's going to be 7:30 for you and 10:30 out on the East Coast. So, good morning, welcome everyone. We're in part three of a four-part series. And looking forward to sharing next week. It's going to be exciting. But this week, we want to talk about what financial blind spots are costing your medical practice. So let's do that without any further ado. The blind spots hiding in plain sight. Um, you wouldn't miss hypertension or low platelet count or something else vital on a patient's chart, but your practice probably does have the financial equivalent. Here are the ones that I see inside practices that basically do new proposal reviews for that look perfectly healthy otherwise. Per provider profitability. Now, this is something that maybe you're not thinking about too much, and that can be understood if you've got more than two of you in your practice. One provider could be quietly running at a loss while another one's carrying the practice for you. And if you don't have a grip on what that number is, and have allocated that through the compensation or other means, you just can't know. And if you can't measure it, you can't fix it. So um, I know it's kind of a touchy subject because you grow to like and even love these people if you're working with them for a while, but it is a vital number. So another is collection lag. This is one that all physician practices that accept insurance are certainly familiar with, also known as days in AR or accounts receivable. If you have over 60 days, you're basically in the red zone. Over 90 days, you're in real danger of having difficulty collecting the outstanding balance. So, um, definitely worth taking a look at. True owner compensation. Too much and you're overpaying FICA, too little and you're risking a bad audit outcome. Now, let's talk about this. Hopefully, at some point, you have been directed to do the S corporation election for your practice. If you're making over Um, I can recommend doing this at even as low as $60,000 a year if you're scaling and you see your practice growing year after year in the near future. This is especially an eye for new practices that maybe you're in their first or third year. Um, if you're making over $100,000 and you still haven't elected S corporation, we need to talk and we need to talk today because I can save you tens of thousands of dollars on your taxes. What you do is you're basically paying yourself a wage first, and then the rest of your net income after that reasonable compensation is what the IRS's term is basically taxable only at ordinary income tax levels. You do not pay FICA tax, Social Security, and Medicare is what that means. So here's the thing. What is true owner compensation? What's reasonable? What's considered reasonable? If you're making less than a physician that does the same thing you do on one of the many salary comparison websites, um, but your net income is lower than your salary, the IRS does not expect you to pay yourself more than you're making. You can't because the money's not there. Okay. So reasonable compensation is an art and a science, and it's something that we've perfected. And if you don't have an idea what that is, um, like we're saying here, you could be either overpaying Social Security tax, or else, let's say you're taking $1,000 a month, but you're making 100,000. That's a huge red flag, and you're just asking to be audited, and you'll pay taxes, penalties. Um, it's ugly. So it's very important to watch that. Okay. Tax planning windows that closed without you. Uh, Taxes is something that you need to keep an eye on throughout the year. You should have a tax savings account. This is a personal account, has nothing to do with any of your business banking, okay? And you should be setting aside, you can draw the money as a owner, a shareholder draw out of your business for it, but you should be drawing out a reasonable amount of money and depositing it into this tax account, out of which you should be making four estimated tax payments a year. We can talk about that another time, but it's basically tax planning 101 for businesses that owe more than $1,000 in tax, whose owners owe more than $1,000 in tax, I should say, excuse me. So, um, let's talk about some of the other tax planning things. The retirement plan funding. Um, if you're running a 401k, your business will actually pay the employer's side of your 401k, and that is actually a reasonable expense of your business. It reduces your net income, and it also increases your retirement future. So, if you're not doing that yet, and the money's there to do it, we should have a talk. Section 179 and bonus depreciation decisions. If you're not familiar with Section 179, that is basically writing off an asset in its entirety in the year that you put it into service. Um, it has to meet certain requirements. The business has to make under 3 million and some dollars, and you can't write off more than $1.2 million dollars. So, also you have to show a profit to be able to do it. But bonus depreciation is back. It was signed back into law July 4th of 2025. So, there are considerations there and a lot of strategies. Roth conversions in a low income year. This makes sense because if you convert from traditional to Roth, you've got a taxable event more often than not, because investments tend to accumulate a gain. But if you have a low income year, you can plan for that with your estimated tax payments and actually convert to Roth, so you can enjoy the money tax free when you actually need it. Uh, Hopefully many decades in the future. And also, when you have no idea what the tax bracket's going to be, it could go back up to 50% in the year 2050. We don't have a crystal ball. So, that for that reason, I love Roth. Each of these is a window and each has a deadline. For most practice owners, that deadline passes without anyone's knowledge. When your tax preparer finally files your return in March, or maybe April if it's exciting, you don't learn what you missed, you just learn what you owe. Okay. And finally, this is a topic that I have cleverly titled the autopilot tax. And what this is money that's draining out of your business that is not doing anything for you, basically reducing your net income without your knowledge or your permission. Now, you gave it permission at some point, but without constant care and supervision, these sort of things can run away from you. Leases that auto-renewed at unfavorable rates, that's a no-no. Basically, if a lease is going to renew, you should have some kind of conversation with the lender. Payroll services billing for seats no longer on the roster. It happens. Software subscriptions. This is a biggie. It's so easy to sign up for software subscriptions. I have them myself. I have to for an accounting business. A lot of the processes that we use require software, but from time to time, I suddenly find ourselves not using these anymore, but they're being auto debited on a credit card. It bears at bare minimum a quarterly review. Monthly is probably better. Merchant processing rates that drifted upward while you were focused on patience. Now, this is always a possibility too. It doesn't hurt to go out there and shop for a better rate. And I can tell you a couple of people that are actually very favorable lately. But of course, um, finding a good merchant is a balancing act because you're probably looking for a number of different things. Um, for example, in my practice, ACH turnover, I need that to happen in 4 to 5 days. So that's something that I'm willing to pay a little bit more for. So again, that's something to keep an eye on. None of these will bankrupt your practice, but all of them are bleeding real dollars, and every one of them is invisible on your P&L because your profit and loss basically summarizes, and tax return, same thing. It doesn't really investigate these causes. The tax return isn't designed to flag things like per provider profitability, collection lag, or autopilot drift. So Catching the blind spots requires someone whose job it is to look for them on a cadence before they compound. That's not your tax preparer's job, and it's probably not your bookkeeper's job either. So, um, this is the third of a four-part series. Next week, we're going to talk about whose job it actually is to do that and what that engagement actually looks like for a practice of your size. So, with that, I hope you have had having an amazing Wednesday so far and an incredible rest of your day. If you have a chance today, do something randomly kind for a stranger. And until next week, we'll wrap up our four-part series with part four and what it looks like to work with a fractional CFO. So